How's it going, everybody? Another day, another earnings week, and this is going to be for the week of February the 26th. Now, as we kick things off on Monday, there's a few companies that are on my radar. First is going to be Del Monte, and it's not that I'm interested in them, but I'm just curious about the health of the vegetables and fruit industry. And then number two is going to be Domino's Pizza. If you know anything about me, I'm very bullish on Domino's. And then, of course, all the way at the bottom, you'll see Pilgrim's Pride. And Pilgrim's Pride is a direct competitor to Tyson's Foods. And both of those companies are in the meat industry. They produce chicken meat, beef, pork, you name it. And on the surface level, without doing a deep dive, from what I can see, Pilgrim's Pride is doing okay. But when we think about Tyson's is actually struggling, and some people might even say that it's undervalued. But as the markets close on Monday, I am not interested in any one of these companies. Let's go ahead and take a deeper look at Del Monte. So currently they're trading for about $23 a share. Sometimes they go up by 50 cents, sometimes they come back down by 50 cents. Their dividend yield is sitting at 3.3%. The annual dividend payout is 80 cents. The dividend growth rate is 25%, which means they are growing this payout year over year by 25%. And the payout ratio is really healthy at 34%. And something that I want to call out on their balance sheet is when we take a look at their top line, which is the revenue, from 2015 all the way to 2022, Del Monte's revenue is sitting roughly at about $4 billion. Yes, sometimes they grow it and then they come back down. It's pretty much flat. And when we look at their net income, it's pretty much the same story. Back in 2016, they had $225 million of net income. And then the following year, it declined by 46%. But when we look at it from a recent trends perspective, it is headed towards the right direction. And then the free cash flow, this is a major red flag. When we look at 2015, their free cash flow was $112 million. The next year, things were looking great. $212 million, an increase of 86% year over year. And as you fast forward throughout the years, what's been happening since 2016 is a decline and a decrease of their free cash flow. And when you look at their recent trend, this is not looking good. For me, I'm going to pass on Del Monte, but I'm genuinely curious about how our bananas are doing. And when you look at their 52-week range, they're currently trading for $23. Their low was $21. Their high is $32. So if Del Monte can get it together and improve their finances based on their dividend profile on a surface level, this looks like a okay investment. But for me, no thanks. Moving right along, the company that I'm actually genuinely interested in on Monday is Domino's Pizza. They're currently trading for about $428 a share. When you look at their 52-week range, their low is $285. Their high is $439, which means the market is bullish towards Domino's Pizza. Their dividend yield is not the highest at 1%, but this is what I want to call out. Their dividend growth rate is sitting at 10%. So this annual payout, $4.84, is increasing by 10% year over year. And the payout ratio is roughly 33%, which means this is a very healthy and sustainable dividend. Now, unlike Del Monte, when we look at Domino's top line, which is the revenue from 2015 all the way to 2022, it has been increasing by double digits. And then as we approach 2019, they finally had a single-digit revenue growth rate. And then during the pandemic, a lot of people were ordering fast casual food. So that explains the double-digit growth right here. But since then, single-digit and single-digit. With that said, when you look at the trend from here to here, that's effectively a 100% increase in their revenue. A good thing to see. And then when we consider their net income, which is the bottom line, almost the exact same thing from 2015 all the way up to 2021, it has been trending in the right direction. They are in the green for the net income. Unfortunately, in 2022, their net income went down by negative 11%, and they posted $452 million. Likewise, their free cash flow went down by negative 30% year over year, and Domino's posted $388 million. Now, going back to the earnings week, there are a few companies that are on my radar for Tuesday. First things first, before the markets open, people are going to be interested in Lowe's, which is the counterpart and rival to Home Depot. And then there's American Tower, which is a cell tower REIT, which I think is a pretty good company. And then there's Cracker Barrel. Unfortunately for Cracker Barrel, they have seen better days because their stock is just getting annihilated right now. And then last but not least, there's going to be Smuckers, which by the way, I've made a full in-depth analysis video about them if you're curious. Same with Cracker Barrel, by the way. And then as the markets close, there's going to be eBay, which some people believe to be an undervalued tech company. However, when I think about eBay, I think about Etsy, I think about Poshmark, Facebook Marketplace, Craigslist. There's just a lot of competition right now. And then there's First Solar, if you're bullish about the renewable energy industry and solar panels. And then there's Extra Space Storage, and then I'll say it here and I'll say it again. I am not bullish on the self-storage REIT industry. For me, this is a easy pass. And then there's Republic Services, which I am a huge fan of. Republic Services and Waste Management, trash companies, believe it or not, outperform the market, which I think is hilarious. And then there's also Bumble, which is responsible for some of the most popular dating apps. And then there's Vizio, which is interesting because Walmart just announced that they will be acquiring Vizio. And then there's Lemonade, that insurance company. And then a meme stock right here, Space Galactic, and another meme stock, Beyond Meat. Okie dokie. So let's take a deeper look at Lowe's. So they're currently trading for about $230 a share. When we look at their 52-week range, their low was sitting at $181. Their high is $237, which means the market is pretty bullish on Lowe's. Their dividend yield is sitting at 1.9%, and the payout ratio is 33%, and they're growing this dividend payout by 10% year over year, $4.40. And when we look at Lowe's top line, their revenue, it has been trending in the right direction for the longest time, which is exactly what you want to see as an investor. Unfortunately, their revenue started to slow down because they stayed relatively flat year over year from here to here. So if that trend continues and they post an earnings which is going to be flat year over year, I think the markets are going to punish them and they're probably going to dip like 2 to 5%. However, when we take a look at Home Depot, because they just recently posted their earnings on February the 20th, the Wall Street analyst predicted that Home Depot was going to post $34.64 billion. However, they actually posted $34.79 billion. So if we make an estimation as to what's going to happen to Lowe's by looking at Home Depot, it looks like their revenue earnings did go down year over year. So $35.8 billion Q4 of last year, and then this year $34.7 billion. So even though Home Depot posted a revenue earnings that went down year over year, the market did not punish them. And as a matter of fact, year to date, they're up by 7.79%. Okay, just kidding. I take back what I said. Even if Lowe's posts a flat revenue earnings, I think the market is not going to punish them that hard. Their net income is kind of all over the place. Sometimes it goes up, sometimes it goes down. And then as of last year, it went down by a lot. And then when we look at their free cash flow, it's the same story. It's all over the place. Sometimes it goes up by 200%, and sometimes it goes down by negative 18%. So it is what it is. I think Lowe's is one of those companies investors really like. Another company that I think of is like Costco or McDonald's. Some companies just have a bigger immunity to catastrophic sell-offs. I guess that's one of the perks for being popular. And the next stock is going to be Cracker Barrel. So right now, they're trading for $70 a share, give or take. And their 52-week range, $62 was their low, and their high was $121. So right now, the market is bearish towards Cracker Barrel, which is kind of sad because it is one of my more favorite places to eat out at. Cracker Barrel makes a mean country fried steak, let me tell you that. Absolutely delicious. And when we look at their dividend profile, this is not good. I don't want to be the type of YouTuber that screams doom and fear. However, when I look at this with their share price declining, I think Cracker Barrel is probably going to cut the dividend by like 25 to maybe 30% by the end of the year. So even though the dividend yield is juicy at 7.3% with an annual dividend payout at $5.20, the payout ratio tells us that Cracker Barrel is using way too much cash to pay for those dividends. And then a company that has been on my watch list for 5 years, Republic Services. They are literally in the business of trash disposal, recycling. You put your trash can out 2 times a week, they come and pick it up and put it into a landfill. Republic Services, ticker symbol RSG, is currently trading for about $183 a share. Their 52-week range, honestly, I do not know what I was thinking. When Republic Services dipped down to $130 a share, I should have been picking it up, but I didn't, and I kind of regret it. So if you look at their high of $183.99, that should tell you that the market is very bullish on Republic Services, because despite inflation or any macroeconomic condition, people are still going to be throwing away trash, whether this is residential neighborhoods or commercial clients. Trash disposal will always be a business that's in demand. When we look at their top line, it's a pretty picture, right? It's going in the right direction from 9,000 all the way to 13,000. And on the years where Republic Services didn't post a revenue that went up, it stayed relatively flat year over year. So it's not a major red flag. And I think that's pretty impressive, because Republic Services does not have the economies of scale that waste management does. Republic Services is still in the middle life cycle of their business, where they're expanding all across the US and North America. So in the short term, I don't think it's going to be unusual for them to continue to post increasing top line revenue beats. And when we look at their bottom line, the net income, this is where the picture gets a little muddy, a little average. So in 2017, they posted $1.2 billion in net income. And then the following year, it went down by negative 18%. And then they went back up a little bit, 3%, and then they went back down by almost double digits. So their net income is a story that's kind of unstable, but for the past 2 years, things have been looking pretty good. And when you look at the free cash flow, I think this is where they make up for it. $755 million back in 2015. And as you fast forward to 2022, they posted $1.7 billion of free cash flow. That's insane. That's a lot of money. Wednesday, the hump day. Before the markets open, there is going to be one of those major Chinese companies, Baidu. There is a small handful of passionate investors out there who are screaming up and down saying Chinese stocks are undervalued. Get in while you can. Me personally, I do not want to touch any Chinese company even with a 30-foot pole. Why? Because when you invest in a Chinese company, their business model does not operate like it does in the West. It's fundamentally not a capitalist structure. As a matter of fact, the CCP, which is their form of government, they have a huge hand in all lines of their business. And with tensions going the way they are across the world, look what happened to Russia, right? The sanctions placed upon them by all the different countries. If China pulls any stunts to Taiwan or Japan or any of the other neighboring East Asian countries, I feel like their economy and their industry and their businesses are going to struggle once a lot of companies start doing like embargoes, boycotts. I'm just not interested in Chinese companies. There's so many beautiful companies in the US. I just don't feel the need or desire to invest in Chinese companies. Okay, before you get all angry at me, let's move right along. There's going to be Advance Auto Parts. And I remember when they were trading for about $120 a share, and then they posted a terrible earnings, and literally the stock market just beheaded them. With that said, I am not interested in them. And then after that, there's a Canadian bank stock that's going to be reporting. And then of course, there's TJ Maxx / Marshalls. By the way, if you are in the market to buy a new pair of pants, t-shirt, you name it, I would honestly visit your local Marshalls or TJ Maxx. And I'm not even invested in them, but you can get good brand name products for like 50% off. Or if you have a Costco membership and you have no shame, I buy my clothes from Costco and Sam's Club all the time. When I was younger, no, you could not convince me to wear clothes from Costco. But now that I'm an old dude, I don't care. And then as the markets close on Wednesday, there's a lot of tech giants that are going to be reporting. And Snowflake is a company that went public during the pandemic, and it's just been a darling to Wall Street. They've been loving them ever since. I almost considered jumping in at one point, but their valuation is a little too high for me. And then there's Salesforce, which I absolutely hate. As somebody that used their products frequently in my corporate job, I really hate Salesforce, their interface, their platform. I hate it so much. However, they're probably going to do okay. And then there's another meme stock, AMC. And then there's Paramount, which, by the way, Warner Brothers posted their earnings this week, and they just got absolutely trashed. So if Warner Brothers is a predictor of anything, I think Paramount is going to be struggling as well. And then as you scroll down, there's HPQ, which by the way, HP has two divisions, right? There's HPE, which is in charge of like their cloud and online business, and HPQ is in the business of actual products like computers, printers. This is a company that I am not bullish on or interested at all. And then there's Duolingo. I have like a 450-day streak going on right now. So shout out to Duolingo, but I feel like I shouldn't say that because even though I've been learning a certain language for a year and a half, I'm still not conversational. I feel like what differentiates Duolingo is that they gamified the aspect of learning languages. However, they are not the best tool to learn a language. That's a hot take, I know. And then obviously there's Weight Watchers, which I think is pretty funny. I had no idea that they were publicly traded. And then the next day on Thursday, there's going to be Ambev and Bud, which is Anheuser-Busch. Both of these companies right here are in the business of manufacturing and producing beer. And don't get me wrong, I am a fan of drinking Blue Moon and Yingling every now and then. However, call me a millennial, but I prefer craft beer. So I'm not really a fan of the mass-produced beers like Bud Light, Budweiser, or Heineken or any of that. Wait, actually, I do like Guinness, which is the beer manufactured in Ireland. Other than that, on Thursday there is going to be Best Buy, is a retail store dedicated to selling electronics. Their main demographic are the older people in our population that need help in person to decide what to get for their needs. And then there's Birkenstock, which is famous for their shoes, and then there's Hormel. I'm going to expand upon this in a little bit, and then as we look down, there's Bath and Body Works, which I don't know why. When I was younger, I dreaded the smell of Bath and Body Works whenever I walked by it in the shopping mall. I can say with sincerity in my heart that their soap products are amazing, but they are kind of on the expensive side. But here's a little tip. If there's a smell that you enjoy, what you should probably do is get your special lady like 3 to 5 soaps as a gift. That way you can also use it in the bathroom. Anyways, Six Flags and Papa John's and then another Canadian bank, TD. Let's talk about Hormel. They're the parent company for a lot of the stuff you see in the deli section: Spam, bacon, Planters peanuts, Jennie-O turkey, but I wouldn't necessarily label them as a competitor to Tyson's Foods or Pilgrim's Pride. Their competitor is probably closer to Kraft Heinz or Conagra brands. So right now they're trading for about $30, give or take. Their 52-week low, $28.51 was the low. Their high was $45.71. Let's go ahead and take a look at their dividend. So Hormel's dividend yield is 3.7%, which is okay. Their payout ratio is okay at 77%. The dividend growth rate is a little less than 5% year over year. So far, things are looking okay. Now, when we look at their revenue growth year over year, it is headed towards the right direction. However, as of last year, boosted sales are coming to an halt and they're actually declining and they're probably going to be flat for this year. And when we look at their bottom line, it kind of reminds me of a standard deviation graph. It starts off at about 890 million and then they went up and now they're on a trend of coming back down. And the exact same story is true for their free cash flow year over year. I guess we can all agree that Hormel did not have the best 2023. Well, let's see what Hormel has to say. So this is straight from their investor relations presentation. So for the rest of 2024, they're predicting a net sales growth of 1 to 3%, which is a very low single-digit number, which assumes that they're going to be relatively flat across the board. But this is what I want to call out. Look what they had to say. The company expects earnings to decline in the first half of the year due to the impact from lower turkey markets, the Jennie-O turkey brand, and lower volumes in the retail segment and softness in its China business. So at least the company is being honest and truthful and not lying like, hey, we might make double-digit growth this year, we don't know. Instead, they're playing it safe and conservative and telling them what's up. And then I actually had a chance to tune into their earnings call. And this is what the CEO literally said, quote for quote: "Looking ahead, our teams continue to navigate through a dynamic operating environment. characterized by slowing consumer demand, inflationary pressures, and headwinds in our turkey business. So, what I took away from that is this: because the prices of their products are going up, less and less consumers are buying their products. And they're basically saying, due to their business operations and supply chain, they don't have a choice to keep prices low. Like the other day, 2 weeks ago, I went to the grocery store and we were picking up canned meat. So, like the spam section. When you look at spam cans next to the generic brands and then companies you've never heard of, spam is like $2 more than any of the other companies. So, as a consumer that's trying to stretch their dollar, I feel like I'm not alone when I say this. Sometimes it's better to just get what's cheaper, especially for a consumable. I mean, it's going to go in my belly and I'm going to poop it out. And if it tastes good, why not? But I think Hormel is not a bad company. And as the markets close on Thursday, let's get back to the earnings week. There's a bunch of companies I've never heard of, like Zscaler, Soundhound. Oh, there's Dell. I don't know why you would ever want to buy Dell over Apple, but it's there. Dell basically manufactures laptops, computers, monitors, etc. And then there's Ginkgo Bioworks. This company is on the verge of being delisted from the stock market. Essentially, it's a startup, and they're in the business of creating genetic matter based on DNA replication. So it's a lot of like biotech happening, but there's just not a market for them. So one of the big things they're working on is like reproducing meat without having to actually raise and kill cattle, and doing a lot of biological research. I wouldn't be surprised if this company files for bankruptcy by the end of the year or next year. And then going down the list, there's HPE, and then of course another self-storage company called Cube Smart. And then on Friday, unfortunately, I'm not interested in any of these. Maybe Fubo, but let's be honest, who uses Fubo? Anyways, those are some of the major companies reporting next week. Let me know which ones you are excited for and which ones you think will do bad. And I hope you have a good rest of your day. Dividend Compounders with Cheese signing off. Stay safe.